your portfolio in June 2026, and you see a sea of red across your tech holdings. You are not imagining things, and the pain is very real. This line chart tracks the Nifty IT index from its March peak down to a defined bottom. From that high point, the index plummeted 34%. That makes for the absolute worst first half of the year this sector has suffered in 18 years. Prices were weighed down by a growing concern that artificial intelligence would automate the high-volume coding and maintenance tasks that underpin the Indian IT business model. If AI could handle these tasks, the traditional outsourcing structure faced a massive threat to its long-term viability. This narrative, that engineers were being replaced by algorithms, pushed sentiment toward rock bottom. The sector became radioactive to global investors, with selling intensifying month after month. Now, look at this dynamic stock chart, mapping the exact same index just weeks later. On July 1st, it hits a 52-week low of 25,699 points. Then, the trend aggressively spikes upward, closing at 31,123 points by July 29th. That is a staggering 21% recovery in less than a month. When you factor in the full month of July, the index posted an 18% gain. That registers as the best single monthly performance in 6 years, matching the massive rallies we saw during the 2020 recoveries. But perspective is crucial here. As this chart zooms out to the year-to-date timeline, you can see that this massive July spike still sits deep inside a much larger hole. The index remains down by more than 20% for the year. A single great month does not erase a full year of massive losses. So retail investors are left staring at a serious dilemma. Is this sudden surge a genuine signal to start buying heavily, or is it a temporary relief rally designed to trap late-arriving money before another drop? To figure out what actually triggered this massive reversal, you have to look entirely outside of India's economy. Global capital was starting to get highly nervous about the concentrated bets they had placed on the Western artificial intelligence and semiconductor boom. The exact tipping point came from overseas manufacturing. Signs of sudden progress in advanced chip manufacturing out of China raised serious questions in global markets. Investors started calculating whether the aggressive AI spending boom in the West was actually sustainable long-term. Fleeing the volatility in high-priced semiconductors, global investors executed a rotation. Rather than exiting the market entirely, they moved capital toward sectors with more defensive valuations, a move often called the reverse AI trade. Fleeing capital behaves predictably. It seeks the cheapest, safest harbor available. In this case, that capital landed directly on the heavily beaten-down Indian IT services sector. This means that the massive 21% rally was, at least initially, an accidental byproduct of global capital flows. It was driven by a mechanical rotation of global money looking for shelter, rather than any immediate, overnight improvement in Indian business fundamentals. To understand why that global capital stayed in Indian IT, we need to examine this dual bar gauge comparing the sector's current valuation against its historical averages. The first pillar supporting this bull run is simply dirt-cheap pricing. The math here is stark. After falling so steeply from its highs, the Nifty IT index was trading at just 18 times earnings. Compare that to its 5-year median of 27 times earnings. That represents a massive, undeniable discount for institutional buyers. The second pillar relies on actual corporate performance. When the June quarter results came out, major players delivered earnings that were largely in line with or slightly better than extremely low market expectations. Management commentary across the sector reinforced this sentiment. They reported that enterprise demand in developed markets was beginning to stabilize, suggesting the fear that AI would immediately cannibalize the outsourcing model was premature. The alignment of low historical valuations with earnings that avoided the predicted apocalypse created the structural pressure for a massive relief rally. For investors who believed the sector was priced for a collapse that didn't arrive, the bounce was a logical consequence. But there is a glaring red flag in the middle of this celebration. Even after a 21% surge, professional global brokerages are deliberately keeping their ratings cautious on Indian IT. Analysts tracking these companies closely are not rushing in with upgrades. Their skepticism is structural. One quarter of stable demand does not prove that AI won't eventually reduce the need for large, human-driven services teams over the next 5 to 10 years. The core threat to the business model remains entirely unresolved. On top of that, there's a serious macroeconomic wildcard in play. The U.S. Federal Reserve just voted to hold interest rates steady in the 3.5 to 3.75% range, with committee members divided on future moves. Indian IT companies rely heavily on U.S. dollar revenue, making them highly sensitive to global capital flows. When the Federal Reserve holds or adjusts rates, it directly dictates how much money flows into or out of emerging markets like India. If Western AI stocks manage to stabilize and that global money feels safe going back into tech growth bets, the exact same capital that just flooded into Indian IT could rotate back out just as violently as it arrived. If you are a momentum chaser jumping into this sector because of a flashy headline, you are taking on massive risk. You are essentially betting that a temporary global money rotation will continue indefinitely, rather than betting on the actual long-term strength of these companies. For long-term investors, the math tells a slightly different story. Acquiring high-quality companies at a steep discount to their historical valuation can certainly make sense, but only if it serves as a calculated, smaller piece of a much wider diversified portfolio. This is absolutely not the time to make an all-in bet. The overarching question of how artificial intelligence will impact global outsourcing over the next decade is still actively playing out. Successful investing right now requires separating the noise of a spectacular single-month rally from the stark realities of global capital flows and structural shifts. As always, this breakdown is to help you understand the mechanics of the market, not financial advice. I want to hear your read on the situation. Drop a comment below and let me know if you're bullish or bearish on Indian IT.